I'm Charlotte McLeod with the Investing News Network, and here today with me is Tavi Costa, partner and portfolio manager at Crescat Capital. Thank you so much for joining me. Great to see you.
Thanks for having me.
Nice to see you. And since it's our first time talking, I wondered if you could give, for those who may not be aware, just a brief overview of yourself and your work at Crescat Capital.
Yeah, we manage a global macro, long, short, and a precious metals hedge fund. So really, I got involved back in the days. I was really covering emerging markets, started doing more macro work, kind of developed our macro process in general, which was sort of more of a quant work, the way we manage our portfolio. And then the macro process sort of naturally became the bigger part of how we approach markets. And so I became a big part of that. And now I manage those three portfolios and given our views about natural resources and precious metals, we decided to launch a fund focused solely in precious metals and base metals. And now that fund is very focused on exploration. So it's kind of, I guess, suiting to be in this conference because there's a lot of exploration companies that we invest in.
Perfect. So thanks for that overview. I think we'll begin with the macro because one of the things that I find is people are more interested than ever in the macro view right now, but there's so many things to consider. And I think a lot of investors have a hard time honing in on what is actually important. So for you, where do you start on breaking through all of that noise?
I think it's a process where you want to figure out what's going to look like 5 to 10 years ahead. I think when you're looking into trying to make money in the markets, I think you want to be identifying the biggest macro trends that will be in the front for it. And so, in my view, we're entering an inflationary environment. It looks more obvious right now because inflation is high and a lot of people have the same view, but it's going to unleash a lot of macro trends. So you have natural resources. There are many reasons why natural resources are cheap in general, not just precious metals, base metals. It's energy, fertilizers, agricultural commodities. And you start thinking about on that front, in dividing up countries, balance of powers, and countries that are going to be commodity-led economies versus commodity-led importers that will suffer from that. So just on that basis, you can have currency exchanges that will be fluctuating differently because of that. So my view has been you want to be long inflationary assets, a basket of those, and countries that will benefit from those terms. My view, Brazil, South America, a lot of places in South America will do very well. And in exchange for the bullishness in that side, I think you want to be a lot more cautious with things that have been working in the prior 10 years. Because usually markets are not as easy as you would think, because the obvious plays are usually not going to work. So the obvious plays are software, technology, crypto, all those things are the things that are actually down significantly this year. And I think there's further to go in those issues. So we're short the mega cap names. We were short back in 2021, software, ARK investments, all those things. Now we're short mega cap. So the Amazons, the Apples, Microsofts, and Googles of the world with some consumer discretionary. So it's basically being long inflation and being short expensive financial assets. That's the best way to describe it.
Okay, and maybe we can talk a little bit more about what's led you to the commodities sector, precious and base metals specifically, because here at this event, we're in New Orleans right now, I think recession is top of mind for people, and one of the questions I keep hearing around is how do commodities perform during a recession? And there's concern about demand and that kind of thing. What would your view be there?
Well, I think we're always trying to fight the last war. So you go back to 2008 when commodities did very bad, and even 2020, there was a crash in equity markets, and it brought basic correlations went to one, everything crashed along with it. Now, it is not my view that we're in a position that we were back in '08. And the real reason for that is because of the CapEx trend. So usually, if you aggregate CapEx or capital spending for most producers in commodities, what you find is that they're actually today at a new lows when adjusted for GDP. So $10 million spent in the ground today is not the same as it used to be $10 million spent back in '08. Inflation has changed, labor market's more expensive, materials are more expensive, so everything has shifted towards that. And so in my opinion, there's another thing that is even more important. I would say the capex trend has become a lot more well known by most investors. The second thing that will become probably as important as the capex trend has to do with the deglobalization. as we see countries, developed economies, having to reshape their manufacturing plants. So, just a little bit of history. Back in the 60s and the 70s, the US economy used to have close to 30% of their GDP in manufacturing. Today is close to 10%. So we're yet to see a large increase of manufacturing in the US, in Europe, in places like Canada, Australia. And so as we see those, we're probably going to see a large demand for cement, copper, I mean, any base metal. A lot of things are going to have to kind of drive those infrastructure developments, and so that's going to be the second backdrop for this or tailwind for the demand side of commodities as we go along in the next 5 to 10 years.
Yeah, and could we talk a little bit more about that deglobalization trend? Because I think that's very interesting. We've been hearing with all of the various events going on in the world about how company or countries need to focus on their own supply chain, right? So especially for resources. So can you talk a little bit more about that?
Yes, I mean, I think we've had, look, there were, in the macro world, there was sort of a debate, is this kind of the 1970s or kind of the 1940s type of inflation? In the 40s, we had inflation. It was driven initially by the war, and then the Fed was, the government was highly indebted because of that, and then so we had to have a financially repressed environment. So there was not a lot of rise in the interest rates. The 70s was completely different, where we did see the rise of interest rates. We didn't see the development of debt. It was a more deglobalized world than the 40s. And there's a catch because the 40s was really at the end of a very deglobalized environment. It was very, very end of the World War II. And I think this is quite the opposite from that. I'm not saying we're going to go to World War III or anything like that, and it may happen, just not. I'm not trying to predict that. But what I'm trying to say is I don't think we're going to really enjoy and take advantage of an environment where you're able to really go to another country and take advantage of a very cheap labor in order to produce your goods and services. And so I think the whole shift is going to have to drive inflation higher over time. And it's not just a deglobalization. It's deglobalization. There's wages and growth, wages and salaries growth that is happening. Is the lack of natural resources and spending in that space. And the fourth one is fiscal. I think fiscal spending in sort of a reckless manner that we're seeing. And so the four ones are kind of like what I call the pillars of inflation. So that's why I think that we're entering an era like that.
Right. And so, as you mentioned, this has led you toward precious metals. That's part of where you're looking right now. And you mentioned exploration, right? Which is interesting to me because a lot of people are saying, you can look at the big companies right now, they're very cheap and they're less risky. So, what about the exploration side do you find so appealing?
I think it's appealing because of where we are in the cycle, and it basically it's not. We're talking mostly about capital trends. There is also a labor trend in this environment where there is a lack of geologists in the space, and so the the real desire for folks to study geosciences, and you look at the secular decline in undergrads and graduate students going to geoscience programs, that is having an impact on the number of folks that can navigate the space. And so it creates a lot of inefficiencies. When you think about the mining space, there's three parts, right? There's exploration, development, and then production. The production is where most of the people that want to get involved, they go there, very first place, because there's liquidity. Most companies already produce free cash flow. So if you're not a financially, or I should say, a geology savvy person, you can then drive your conclusions by looking at cash flow and doing analysis and fundamental analysis of those businesses. Now, the development phase also favors a lot of financial work. The exploration phase only favors geology. And so because of that, and because of the lack of folks that can really navigate that space, there is a ton of inefficiencies here. So we think this is the time to be allocating capital here, knowing that most of the majors are also going to be facing a supply cliff. So they've been depleting their reserves and not really replenishing those reserves over time. So they're going to actually, at some point, have to be purchasing, or either purchasing or actually doing their own exploration. And so the way we approach this in our portfolio is sort of like a hybrid venture capital fund. So we think about, we've done over 90 investments, and in our opinion, about one third of those are probably onto discoveries. One third of them, the other one third of them are probably not yet into discoveries, but are staying on the script. And the other one third are just not going to be winners. But the traditional venture capital approach, you only have one or two winners. And given how depressed the market is, you're able to buy things that are probably onto discoveries and have a very high probability of actually hitting something and finding a discovery at really cheap multiples. And so I don't know. I think ideas are driven by inefficiencies, and when you find those, you just want to exploit it. And so we're doing that full cylinder, and hopefully we'll be able to make a lot of money.
Hopefully. So, criteria for looking at exploration companies, are you looking for companies that would be a takeout target, like for the majors that need to replenish their pipelines?
I think that's one side of it. I mean, it doesn't necessarily need to be the one. I mean, I like to invest in things that have a lot of optionality. And optionality doesn't necessarily mean that they're going to be, taking over. That's one side of things. We can also, I think there's going to be a lot of consolidation in the space, not only through the majors coming into the smaller names, but maybe into the smaller names as well. So putting together companies that are in the surroundings, that have similar deposits, that have folks that can create synergy and creating the new Newmonts and Barracks of the world. So this is sort of the focus. So not necessarily driven by those guys buying them, but perhaps by them creating the new bigger companies. And so we're getting involved in a more activist way of helping those companies to develop those businesses in a further way. So it's there's the other backdrop, which is the macro. If you get a bullish macro environment, which I'm a bigger believer for many reasons, on the gold market, silver market, copper market, cobalt, and so forth, that on itself can actually increase the value of those companies and create liquidity. I mean, we've seen this in the past. And remember, majority of the billionaires in this industry and the most successful people in this industry actually made their money in exploration, not in development, not in production. So, taking a systematic approach into that side of the industry, to me, makes a lot of sense.
Yeah, that's a great point. And when we talk about bull market coming for these commodities, I know a lot of people here are feeling a little bit sad about the gold price, silver price, performance there. Are you looking at prices for the metals? Do you have expectations moving forward? Are you focusing on companies that can do well, at any time?
I mean, it's not the end of the world. I think it's allowing us to buy deals at incredibly cheap prices right now. I am very focused on building a very chunky and valuable portfolio the best way as I can before a big move. And I think that's really the way, as I said earlier, you want to be early in a big macro trend. And I think we're early here, and this is important because you're establishing yourself, you're owning the best things you can own, and once the wave comes, you really own the highest quality projects out there. And so, to me, this is the most important part. And you can only strike those really good deals right now. I mean, this is the time. So, nobody is really focused on silver. Silver is not going away. Gold is not going away. Copper is not going away. It's all going to be with us for many years and decades and centuries. And so, it's time to be, I think, value and macro investors need to be taking the approach of buying things that are cheap, that have the likelihood of doing very well. And to me, this is a classic case of something that is unique and also completely forgotten. You look at the sentiment; everyone is negative about it. I'm very far from that. I'm very positive, and I think this is an incredible opportunity.
Okay, and I've got, I think, just one final point. So I know on Twitter recently you're talking about energy stocks, and these are disconnecting from the rest of the market, right?
Yeah.
So for you, is that something that's already going like this is kind of too late?
No, I mean, any market that goes up 1 to 2 years in a row, it's going to become a lot harder for you to make money in the third year in a row. And that's kind of where we are in energy. We made money in 2020. 2021 was actually the best year, annual performance for exploration production companies in 30 years. 2022 came in very strong. Most of those companies are up a lot. Then we had a pullback. But historically, you look at the valuations that we have in most of those markets, especially in energy, it's still trading 11, 12, 13, 15% free cash flow yield. I don't know. You tell me if there's any sector that is selling at those levels. I can't find one. So, and you can go a little further. I've been, part of my talk here was to really share, a growing conviction in Brazilian assets. I've been growing my conviction in what I think it's going to be Brazil in terms of partnerships, and especially given this commodity-led economy that will benefit from this environment. And so you find companies there trading at 5 times earnings. I mean, this is really, an opportunity in my view. So I've been looking at those as well. And I think, even just give you a very quick stats here. If you look at the overall S&P 500 divided by sectors, um, the sector that's paying higher dividends today is actually energy. You don't buy energy companies for dividend purposes. You buy utilities and REITs and so forth. And so this is just the level of imbalance that you're seeing. Those companies are paying really high dividends, doing buybacks. It's just very attractive right now to be allocating capital there.
Okay, that's all for me, unless you had any final words of advice you would leave investors with in these interesting times.
Um, I think just my final, I guess, advice or piece of hopefully smart words here is that right now in the macro environment, you have kind of two things going on. There's folks that are really believing in the technical thesis because things are somewhat oversold. It's the only thing going for the bullish thesis. But this is a time when the macro takes over, and the macro environment is extremely pessimistic right now. And I think people need to be taking advantage of what it could be a recession and buying things that are going to be doing very well in the following 5 to 10 years. And in my opinion, those are going to be inflationary assets. So be aware of those dislocations because it's going to be a pocket of opportunity, in my opinion.
Okay, well, thank you so much. Great to get your thoughts on what's
Thanks.
going on in the markets. Once again, I'm Charlotte McLeod with the Investing News Network, and this is Tavi Costa with Crescat Capital.